In this video, we're going to be taking a look at gearing ratios, which is all about the capital structure of the business. So these ratios kind of help us establish, how much of the company's funds that they have in the company, right? How much is funded by borrowing compared to equity capital, which is the shareholders' funds. So obviously, we want the capital to be mostly coming from shareholders, okay? Because when it is the majority debt capital, that means a lot of your profits are going to be tied up paying interest. So when we're looking at this, there's going to be three formulas that we're looking at. You will see in past papers, the majority of them were looking at gearing percentage and interest cover, but in the last couple of years, they have put the debt equity ratio into the marking scheme. So I'm just going to teach how to do it here as well, just in case you want to throw it in. I don't think it's ever going to be a compulsory component of it, but I'm just putting it in to just cover all eventualities there. Okay, so first of all, we've got the gearing percentage. This compares the debt capital to the overall capital employed of the business. Interest cover, which uses the operating profit, finds out the company's abilities to meet its fixed interest commitments. So high cover indicates the company has no difficulty meeting commitments. Basically, it is what is your operating profit? How many times is your operating profit compared to your interest charges? And yet you want it to be as high as possible, because when it's higher, it's going to be a lot easier to pay the interest. And the formula there, operating profit over interest charges. And your answer will be in times. And then we have the debt equity ratio, and this compares the debt capital, the loans, debentures and preference shares, with the equity capital, which is ordinary shareholders funds and reserves. And the formula there is debt capital over equity capital multiplied by 100. Okay, so let's get started. So when we're doing this, I'm going to do the gearing percentage and the debt equity ratio together, because it'll just be a lot easier to for you guys to do them together. And remember, this debt equity ratio, I'm putting this in here as, just covering all bases, but I don't think you will have to put it into your part B, but you might wish to do it anyway. They've just started to include it in the marking scheme, so I think it's wisest that I do include it here. Okay, so 2021, so we're going to go and we're going to do back as far as 2018 together, and then you guys should be able to try and start calculating them all yourself. Okay, so the gearing percentage. So what is the formula? It is your debt capital, which is all your borrowings, over your capital employed multiplied by 100. So just looking over here, this figure here is your capital employed. It's all of the money that is being pumped into the business. The debt capital is €250,000 here and €100,000 preference shares. So they are the two, you'll notice, that have the percentages beside them. Okay, so in this question, it's 250 plus 100, and that is over 621 capital employed. Multiply that by 100 and you get 56.36%. And anything above 50% is highly geared. So highly geared, we don't really want it to be highly geared, because highly geared means a lot of your money is going to be tied up in interest payments. Now last year it was 62, which is also highly geared. So this year it's better. You want it to be 50% and below. So this year it's working its way down towards 50%. So at least it is a positive trend. It's still highly geared, but it's a positive trend. Okay, the debt equity ratio then. So the formula for this is our debt capital, which you saw was the two with the percentages beside it. So 8% and 9%. So the 250 and the 100 over the equity capital. So equity capital is shareholders' funds. So 200,000 plus 71,000. So overall there, it's 250 plus 100 over 271. Multiply that by 100 and we get 129.15%. Now, if you wanted to get last year's, it's not written down here, but if the gearing percentage last year was debt capital over capital employed multiplied by 100 was equal to 62%, that means that the equity capital would have been 38%. Therefore, if we put it into the same formula here, 62 divided by 38 multiplied by 100 is 163.16%. So yeah, it is a positive trend. So like, you know, it's going to be a positive trend because the gearing percentage was positive as well. Now, I don't think you're ever going to have to include this information, but that's how you would calculate it if you wanted it. Okay, 2020 Robinson PLC. So we can see here last year it was highly geared at 55.76. So let's see what the gearing percentage is. So debt capital, okay, which is your debentures and your preference shares, over capital employed, which is your 1182000. It's all of the money that you've employed in the business, multiplied by 100. So 400 plus 200 divided by 1182 multiplied by 100 is 50.76%, which is still highly geared, but it's in a better position than last year's 55.76, which was also highly geared. So it is a positive trend, and so it is percentage that those workings should work out to. So 50.76% and 55.76% for last year. Okay, the debt equity ratio here. Formula, debt capital over equity capital multiplied by 100. So our debt capital, as we saw before, 400 plus 200 over equity capital, which is our 460 and 122. Multiply that by 100 and we get 103.09%. Now, if you wanted to work it out then for last year, I don't think they're ever going to request that you do this in the exam, but we never know. But if you took a look at the gearing from last year, that is 55.76%, okay? So therefore, that would mean that the equity capital, if this is the debt capital over capital employed, is 55.76, that means that the equity capital would be 44.24. And so if we put that into our formula, 55.76 divided by 44.24, we would get 126.04%, which would make sense because then that is a positive trend. So the debt capital is less now this year. So that is that. Now, 2019 then, Shannon PLC. So gearing percentage. So formula is debt capital, okay? So your debentures and your preference shares over capital employed, which is all of the money that has been employed in the business. So all the money that's been pumped in, 1087, multiplied by 100, and that will be in a percentage. So 250 plus 250 over the total capital employed, which is 1087, multiply that by 100, and that is 46%. So that means that the business is lowly geared. They have less debt capital than equity capital. Okay, so 46% is lowly geared, which is what we want, because when we're lowly geared, it means that we have more, profits to be able to keep in the business instead of paying loads of interest charges. So last year, the gearing there was 56%. So that was a highly geared position. So overall there, that is a positive trend. Okay. Now, if we were doing the debt equity ratio, again, the formula is debt capital over equity capital multiplied by 100. So our workings here would be your 250 plus 250 over 500 plus 87 multiplied by 100. That gives us 85.18%, which makes sense because that is less than 100. That's lowly geared there as well. Now, again, if I said to find it for last year, as I said, I think this is going OTT for the exam, but I don't think they're ever going to look for this. But if the gearing last year was 56%, that is debt capital over capital employed, that would mean that the equity capital would be 44%. So therefore, debt capital 56 divided by equity capital 44 multiplied by 100 is 127.27%. So that is definitely a positive trend. Okay, so I'm going to be quiet from now on and just go through the workings. So you can pause and play this video as you please, but practice the gearing percentage and the debt equity ratio, and hopefully you'll get on all right. Okay, so that is all the gearing percentage and debt equity ratio working's done. I hope you got on all right there. And just a reminder that debt equity ratio has only just started to appear in market schemes in the last couple of years. They haven't been compulsory. When I have been correcting, it hasn't been compulsory that you do them, but I'm just going through them just in case, just anyway. Okay, so the other gearing formula that you need to look at is interest cover. So this measures how easy it is for a company to pay their interest charges on loans. Okay, so this one here, interest cover, uses the operating profit figure, which is your profit figure before interest and tax and dividends. Okay, preference dividends. So that's your operating profit figure. So that is over your interest charges. Okay, and your answer will be in times. So basically, how many times is your profits compared to your interest charges? So the workings are 39 plus 20. So that is your operating profit figure. Your operating profit figure would be in here somewhere. Okay, that would be where your operating profit figure is. So 39 plus 20 is your operating profit. That is over your interest charges of 20, and that is 2.95 times. So your profits are 2.95 times your interest charges. Now, last year they were 3.2 times. So we want the interest cover to be as many times as possible, because we want it to be as high as possible. So unfortunately, that is a negative trend. Okay, in 2020, interest covered the last year was 7 times, but let's look and find what is it this year. So operating profit over interest charges is our formula, and our operating profit figure would be in here. So it is your net profit, add back in your interest, because your operating profit is your profit figure before interest and tax and everything else. So 104 plus 16 over 16, and that is 7.5 times. So as I said, we want it to be as high as possible. So that means that it is a positive trend. Okay, 2019 Shannon PLC formula, operating profit over interest charges. And our operating profit here would be our 90 plus 15. So operating profit would be in here. So that is your profit figure before interest and tax and dividends, etc. So 90 plus 15 over 15, that is 7 times. So last year it was 4.3 times, and as I've just said, we want our interest charges to be as high as possible, so that is a positive trend. So the interest cover is higher, that is ideal. We want it to be higher, so that is positive. Okay, so you're going to get practicing a few yourself now, and you can pause and restart the video as you please. Okay, so that is all of the gearing formulas done there now. So we had the gearing percentage, we had the debt equity ratio, and lastly there we had the interest cover.